Art Hogan, Chief Market Strategist, B. Riley Wealth Management, is with me now. Good morning, Art. I hope you had a nice Thanksgiving holiday. How are you feeling about the economy in particular, because that will drive what the Fed does next?
Yeah, really well. We're finally going to start to get some inline economic data, some not dated economic data this week. And I don't know that we're going to get anything that sort of tips the apple cart into a place such that the Fed doesn't see their way clear to cut rates. Now, it's not going to be a unanimous decision at the next meeting, but I certainly think there's enough support behind the fact that, while the PCE at the core level likely won't be close to target and be closer to 3%, I think the concern over the softening of the labor market hasn't changed much. And I think that really drove the decision back in September and clearly will drive the decision again in December. So whether or not we see a hotter PCE, which isn't likely, we know about 80% of the components of the core PCE once we get a CPI and a PPI. So that's pretty well known. I think that, we may have a split decision, maybe a 7-5 vote, but I think the Fed cuts again in December. Agnostic to what we see this week and some of the other data, things like the ISM manufacturing certainly comes out later in the week, and some other prints that are now real time. We'll get a new University of Michigan consumer sentiment survey, but I think the Fed's got enough evidence in front of them that we're just not creating enough jobs on a monthly basis to keep unemployment in check.
So they'll be more concerned about the jobs picture, even if whatever comes in with this PCE print on Friday. Also, it's such a lagging print. I mean, unless it's off the charts and makes them scratch their head, they're probably still going to go with the cut. When we think about what goes on in the new year, we were talking about quantitative tightening ending now. It's essentially now quantitative easing, and that often gives a little boost to the market. Do you expect the Fed will continue to cut in the new year? Should they cut?
Yeah, I think largely dependent on what the economy looks like and the path of economic activity, especially if we continue to see weakness. If we don't see the labor market firming up to a point where unemployment stops rising, right? We've gone from a low of 3.8% up to 4.4% in unemployment. That likely continues to tick higher. Now, that's not alarming in and of itself, but directionally it certainly is a concern for the Fed. And one of their mandates that they're likely to defend a whole lot more than the inflation mandate, because part of that inflation picture is coming through core imported goods, which we know is a one-time event, will anniversary over the course of the next 6 to 12 months. So I think the Fed likely has a window to cut at least 2 more times next year. That's what they penciled in their last summary of economic projections. That's probably close to where they think neutral is at this point in time, and that's where they'd like to get. They'd like to get from being a bit too restrictive to being closer to neutral. They never know where neutral is, but I assume around the table 2 more rate cuts at some point next year fills in that blank.
I was looking at some of the price targets for 2026. I mean, Deutsche Bank is on the high end, of course, with their 8,000. But most of the brokerages and banks or whatever, I see 7,100 from Bank of America, HSBC 7,500, Morgan Stanley 7,800. What do you say between now and the end of next year?
Well, I'll tell you this. We just wrapped up a great third quarter earnings reporting season. What was important about that was we had the third quarter in a row of double-digit earnings gains. Estimates for the fourth quarter and for next year went up. So the estimates for next year for the S&P 500 are for low double-digit earnings gains. I think if you were to put a normalized multiple on that, we could certainly see, a 7,700 S&P 500 by the end of next year, just using the fundamental math. Now, it's always a tricky prospect to make that, call in December and look out 12 or 13 months. But I certainly think if estimates stay in place or get better for earnings for the S&P 500, and we use the same multiple that we've ended the year at for the last 5 years, it certainly gets you, around that 7,700. Now, all of this is going to be dependent on, something not blowing up, the economy slowing much more precipitously, the Fed having to actually come to the rescue instead of just getting to neutral. But as we look out right now, I think the fundamentals are more good than bad.
I also think that, look, the obvious is that no one has a lower price target. They all think that there's room to the upside, at least, whether it's 2%, 10%, whatever it is. Look what happened with Bitcoin, which is down 20% in a month, and now people are saying it's going to be back to new highs by the end of even January. So I'll put that aside for the moment. What about just the seasonality of December and Santa Claus rally? Are you anticipating that we might get that?
Yeah, some of the seasonals haven't played out very well. We had a very calm September and October. November was rocky in the front end, but it hit a low on the 20th and bounced nicely. That piece played well into seasonality. Seasonality around December is very good, and on average over the going back 50 or 100 years, it's one of the better months and typically up 1.3% or thereabouts on average. So I think the seasonality and the fact that we did the washout in the first part of November sort of helps that concept around a Santa Claus rally. Also helping that is the fundamental fact that we're going to start to get economic data, and we will likely have another rate cut to throw into the mix, on top of the fact that earnings growth for the third quarter was certainly better than expected, significantly better than expected, and earnings estimates for the fourth quarter have gone significantly higher. So I think we can trade higher into the end of the year. And that doesn't mean we can't still see some of the washout that we're seeing on the more speculative edges of the market. So some of the hyper speculative names, and certainly cryptocurrencies kind of falling into that bucket, and tends to be very high beta when the ultra speculative edges of the market sell off. I think it's okay to continue to see that washout, but I think in general, when we look at the S&P 500 on balance, we're probably going to see a drift higher, certainly at the end of the year, and close at new highs.
Do you turn to some of the Mag 7 names as your long-term holds? I know they've been volatile, but some of them are just, sort of good old names that we know. What do you say about some of those tech names?
Yeah, if you take the Mag 6, take Tesla and you make that its own use case, and take the Mag 6 and say, how are we trading in terms of valuation? So the average PE sits at about 32, which is very fair for companies that have an average earnings growth rate between 50 and 60%, throwing off gross margins north of 65%. So in terms of valuation on the AI darlings or the Mag 6, I would certainly say they look very good. And I think that what happens inside of that is you get this rotation. At the beginning of the year, nobody wanted Apple, and now Apple has kind of declared their AI strategy with partnerships through Alphabet, and certainly they'll announce another partnership for international AI to make Apple Intelligence that much stronger. I think Alphabet has certainly taken over the lead from the early leaders like Microsoft in the AI race. So internally, you're going to see some rotation, but I certainly think that as a group, they continue to look to be the most attractively valued in the last 2.5 years since ChatGPT rolled out, and continue to throw off significant revenues and earnings.
AI it is. My goodness, the Mag 6. Okay, no Tesla, I got it. Art Hogan, great to see you on this Monday. Thanks for kicking off this busy week. Appreciate it. Chief Market Strategist, B. Riley Wealth Management. Always great to see you, Art Hogan.